Okay, in this video I want to finish looking at flash panning, and I was talking about the fact that morning movement is tricky. It's tricky because, well, you don't know why someone, okay, is actually, see, the thing is, for the stock that is gonna sparkle like this for one day, remember, it's a very low stock. It's not necessarily a hot stock because the media is not talking about it. And if you look at its past history, it really hasn't moved much, but it's moving today for some reason. You got to ask yourself, why are people all of a sudden buying this when it's not in the news? And you also have to remember that for every person that wants to buy it, there's someone out there who wants to sell it. So it really skews the perspective. If you look at a stock and the volume of the stock says, 500,000, that means that there are already 500,000 shares that have traded places. It skews the perspective to say that there are 500,000 buyers out there, or that there are a lot of buyers. There's an equal amount of buyers and sellers. There has to be. For every one buyer, there was one seller. Okay. Well, actually, no. It doesn't have to be that way. It's see, that's the point. It doesn't have to be that way. So I'm going to back up on that a little bit. But the point I'm trying to make is that for everyone who says, I got to get rid of this thing, because if it's stellar, why would they want to sell it? If it really has that promise, why would they want to sell it? Well, they might have to. A bank might have to sell it to meet liquidation. Okay. The amount of liquidation or actual money on hand that they have to have by federal regulation. So they might actually, somebody might actually, it might actually be a decent stock, but somebody might have to sell it for other reasons. But what about all the others? So if that's only that one buyer, so basically if there's only one, seller out there that's getting rid of it because they have to, then that might be a pretty good deal. But the other thing is, if the whole activity is being generated by the trading of one seller, then you don't have that action is going to stop. That growth is going to stop as soon as that buyer is done selling. As soon as that seller is done selling. So what I'm trying to say is that if you have a stock like XYZ or whatever, and everyone is just kind of holding on to that stock, and this bank has 3 million shares of it or whatever, and all of a sudden the bank realizes we're below our allowed amount. We need more liquid. We need cash. We need more liquidity now. So you realize as soon as you have stock, as soon as you spend your cash to buy stock, you don't have cash. You have stock. So you can't go and trade that stock for some other stock. Not through the online market. So you lost your liquids, okay? You lost your liquidity. To get it back, you're going to have to sell something to get those numbers back on your portfolio, stock buying power or whatever, the cash back, so that you can spend it to buy another stock. So there are lots of reasons why someone might actually want to hold on to a stock, but then have to sell it because they need the cash. They would rather have the stock and the cash, but they can't. But they absolutely need the cash now. So they got to get rid of something. And they said, we're just going to have to let the stock go, although we want to stay with it. So if you have one big bank that's deciding to do this, they're going to sell. All right, they're going to sell. But what if they have 5 million shares? And this is a small stock that doesn't do much trading day by day. Let's say the average amount of shares exchanged day by day is like a million. All of a sudden, it's going to be 5 million because this bank wants to sell. It has to sell. So this is going to be the flash, because the bank is not going to sit around and say, well, let's just negotiate now. They're going to say, we need this money by the end of the business day today. So let's sell in 10 lot packets. In other words, 1,000 shares at a time. Let's sell 1,000 shares at a time. Now they have 5 million. So this is going to be 5 million trades, right? It's going to take much of the day. And because they're selling at little increments at a time, they're meeting, and they have to sell right away. Okay, so they're not going to be negotiating on this. It's like, okay, they want to sell at a certain number. let's say they want to sell it, let's say it's a 50-cent stock and they want to sell at 50 cents. But at that moment, right then in time, there's just somebody that says, well, actually, you know, I don't, at this point, I don't want to get into the actual numbers, okay? Let's just say that all of a sudden the stock starts moving because they're selling right away. They're selling packet after packet after packet after packet. And because of the volume, let's just say all of a sudden the price of the stock starts going up because it appears like it's a desirable. People are forgetting that there's the balance of selling and buying is going on. For everyone who buys this thing, someone is selling it, the bank. They might start thinking, oh, there's a lot of people buying this. It's very desirable. Let's jump on board. Let's buy it. Let's buy it for 51. Let's buy it for 50. So they themselves are kind of pushing the price up a little bit, okay? Whereas the bank has just kind of set the thing on autopilot. Just meet any bid out there, all right? And it starts going up. And if it's just this one big seller that's trying to get rid of all this stock because it needs cash on hand for tomorrow or whatnot, as soon as that, can you see how as soon as that bank runs out of its 5 million shares, the actual buying frenzy is going to stop? Because, well, it was just one big seller. And all these people came to buy little by little. Because it's like this big seller had this big loaf of bread. It was just breaking up little crumbs and just selling it to the market as fast as they could. So think of like a big bread loaf, and you're out at the river and you're feeding the ducks. You get a little bit off and you throw it out there, throw it out, and you know these ducks come around and they start fighting each other, and more ducks, and you're going as fast as you can with the bread and more ducks. And so can you see how like there's going to be this apparent demand for that stock, and it might push that price up. But it's not the bank's fault. The bank is just getting rid of all this stuff, okay? And as soon as the bread loaf is done, you're going to have all these ducks sitting around waiting for more, and more is not going to happen. And you know what's going to happen? The market, remember the serration? You know, remember the, you have a stock, let's see, you have a stock that's, you know, it'll do this over the course of its life. Well, not life, but let's just say over a month, if it's moving like this, you got to average all that out, and the real line of growth is something like this, okay? That's the one that you can depend on. So, you know, for this one day of heavy selling, because the bank wanted to get rid of it, it went, you know, it went like up there. And guess who went in there to buy it because you're flash panning? You. And you bought right here, or right here, because you were a little too late, because this happens right in the morning. Now, I should say this. Now, I actually should say this in another video so that you can have this localized. But here's a very important thing to remember. For the average person that's going to do this on their own on an online venue with a cash account, that means they can only buy, they have to actually buy the stock and then sell it later. That's the whole idea. They can do it only between 9:30 and 4. Okay? Now, you can watch after-market activity happen on your account. You can see the numbers change and all that, but you can't partake in it. If you try to put an order through for these discount broker shops, it's going to tell you, thank you, we've got your order. It cannot be executed until opening bell next day. So they're going to hold on to your order, and as soon as 9:30 hits the next day, they'll execute it. But the thing is, the street, Wall Street, can actually trade after hours. They can do, the banks and the people that, I guarantee you, they're not dealing around with these online broker shops. Many of them own these things. They're not paying commission. They're not losing that sort of money on just making trades. And they're not tied to those traditional hours. So some of these banks trade 24/7 almost because, you know, although the American market might shut at 9:30, the Asian markets open at 6 p.m. our time. That's when they open. So, you know, now well, let's just go trade on the Asian market. So they in theory, they don't have to ever stop trading. And they can be trading at 8, 9 o'clock at night. Now, it's not going to get on the record as a trade if it happens after 8 p.m., but they can still be trading this stuff. So you are at a disadvantage if you're doing an online broker thing because you have to stop at 4 p.m. You cannot make a trade after 4 p.m. until 9:30 the next morning. This bank could have started this whole thing of selling off XYZ at 6 in the morning if they wanted to. you know, it would have been off the market. No, actually, it would have been on the early morning market. But anyway, are you going to be able to convince yourself that you're not late when you see the flash of the pan at 10:45? You probably are late on this thing. So, and as soon as that one big buyer, or excuse me, one big seller ends its inventory, all of a sudden people are like, "Oop, well, nobody wants to sell anymore." You know? Okay, so I'll start selling. So some of the ducks will start selling right then and there to capture 2 or 3 cents. But then everyone starts selling, all right, and it's not. They don't have 5 million shares to just keep on. Let it go. As soon as they finish selling their 1,000 shares or 2,000 shares, then the mark can be reset. Someone can say, "Well, I'll sell, but I'll sell at a little lower price because I want to sell at this higher price, but no one's biting anymore. So maybe I'll sell at this lower." And then there's a rush. It happens in the afternoon, a rush to get out of the market. Okay, among the ones that were just buying. So they're going to settle for lower prices, all right? And what's going to happen is you're going to have, this is typically what happens in the early morning for the flash in the pan thing. You have the stock kind of climbing like this, and then you have a plateau, and then you have this number. And you know, I don't want to put strict hours to it, but let's just say that this could happen anywhere from 11 to 2. But you know, for the average of all of this, okay, from 2, or let's go from 3 to 4:30. I'm sorry, from 3 to 4, it goes down. Okay, people are trying to get out because they know what they're doing. They might not call it flash in the pan, but well, actually they call it scalping. But they need to get out. They know that this is a dead stock. Really, this is just the one time it was hopping. Now, if you're not aware of that, if you're not ready to take that sort of commitment to get out at the end, before the close of that bell, even if you have to take a loss, you might get trapped in. Okay, so you didn't want to get out there, but you bought here, but you didn't want to get out there, and then it starts dropping. You're like, well, if I get out now, I don't make a single penny. I hope it goes up again, but in fact, it doesn't. It keeps on dropping, keeps on. Now you lost money, and guess what it does? It drops down a little bit, and then it comes back up, and it stays here. Okay, it stays here, or it might be doing this sort of stuff on this side, like this, for another 5 or 6 months. But you know, here's the top. You bought up here, you're still taking the loss. Even if you buy at a top day a week from now, it's probably not going to be as hot as it was right there in the flash of the pan. So this is really tricky. I need to talk about 2 more things quickly. HTF competition. Okay. It's high, it's HFT. HFT competition. That's called high frequency trading. And this is when the machines do it. The algorithms, and so you're actually competing against the machine. And the machine can do its computations a whole lot faster than you. So if the success of your own trade depends on your being able to calculate how much profit, how much time, what the trends are, what the orders are like, what the volume has been trading at, and all that, the machine is always going to beat you. And the thing about HFT trading is it for these machines, it happens in nanos. I mean, thousandths of a second. They'll do these sorts of tradings. Now, what I would suggest to you, okay, is I threw this term out to you, HFT trading. Or, actually, no, high frequency trading, HFT. Google it, read a little bit about it, see why it's dangerous to the everyday investor. Because they will do their high frequency trading in these sorts of markets. The markets that are open to the middle class investor with an online discount broker site. The last thing I want to say is, problems here is the time sequestration idea, and in other words, it's going to take a ton of time for you to do this. And if it's this delicate, if you have to keep an eye on the graph this closely, because it'll dip in a second and then it goes on down, or like within 15 minutes or 20 minutes, or you don't know when, 5 minutes, 30 minutes, do you have an hour, do you have 15 minutes? You have to be on your toes with this. Okay, so you got your computer up, you're watching your graph, you're watching all this, and you watch it for 30 minutes, and then you watch it for an hour, and then you're telling yourself, why better, maybe I'll just stick in for 5 more minutes, and then you're watching for an hour and 15, an hour and 20, an hour and 25. Really? Are you okay? Now let's say you divvy up your cash account so you can trade 4 times a week, which is kind of hard to do. But let's say are you really going to spend 3 hours every day for 4 days out of the week doing this sort of thing? Just watching and an hour to 30 minutes to find the stock, an average of an hour to watch it grow and sell. So let's just say an hour and a half every day between 10:45 and lunch. Well, what about your school? What about your job? How are you going to make time for this? So it really does take out its pound of flesh in terms of actual minutes and times of the day that you have to spend on this. And I don't know if we again have we been called to spend this much time worrying about money, the sole act of making money, by trading on the markets, by trading these sorts of commodities. All right, remember, you're not producing anything, you're not making anything, you're not developing a skill in the sense of a skill that services others, a skill that reminds you of the God echo of creation. You're just watching these little things determining when to trade and when not to trade. And was this why you were created? Because you're spending a whole lot of time on it. You end up spending a whole lot of time on it, mentally, preparation, the actual time of selling, not to mention the way it can affect you emotionally. When you do make a good sale, you're pumped up and high. When you lose, you get a little depressed, a little sad. I mean, it has other costs to it too. But anyway, that's something to perhaps beside the point to the method itself.